milestone and now has more than 1.8.
Good evening, everyone.
Good evening, sir. Good evening.
Hope,
Good evening.
Good evening. Good evening.
Good evening, sir.
good evening. So, hope every one of you is well and energized after the weekend. Today's session is about finance and business. Why finance and business? Whatever you're doing as a manager, you're supposed to be linked to finance and business somehow, because in the end, if it's a for-profit business, the ultimate goal is to do some savings in facility management or generate profits. Or if it's even a non-profit organization, you should be monitoring your costs, working within budgets, and achieving your appointed targets. So for that reason, no matter what you're doing as a manager, you're always supposed to have a working knowledge of finances. Those of you who are familiar with financing will find this a little bit easier. Those of you who are not, this will be a good introduction into the financing and business. Again, you're not expected to be a chartered accountant, but you're expected to know the basic of finances, the basic of accounting. What is a budget? What are the different terminologies of a budget? What's a capital asset? What's a running asset? And so on. So these basic things that maybe you've heard before, now we're going to be covering them in this session. So to start, we'll start with the definitions. So again, reiterating, the facility manager should showcase to the top management that investment in FM is not a liability, it's a cost-saving strategy. A problem which we face in facility management is that facility management is considered as a cost center. I'm not talking to the case where we are as a facility management service providing company, but if it is regarding our own assets, if we own a hospital, if we own a mall, if we own a hotel, facility management is recorded as a cost. And as mentioned earlier, the majority of cost of the lifespan of the building is not in its construction cost. It's in operation and maintenance cost. Because a building construction cost, you will pay it over 3 years. But a tower, for example, you will pay the construction cost over 3, 4, 5 years. Excuse me. And then the operating span of that's going to be the lifetime of it, maybe 20, 30, 40 years. So you're going to be paying millions and millions over these years. And hence, facility management is considered in the traditional sense to be a cost center, but our goal is to show it's not only that it's a cost center, it's if you don't invest in it, it will become a liability. What does that mean? If I don't maintain my equipment properly, if I don't hire the right people to handle my job, then I'm gonna end up, saving pennies now, but ending up paying millions down the road. Similar with your vehicle. I always like to give the example of your vehicle. If you got a new vehicle, brand new vehicle, you're happy with it, everything is working fine. If you act cheap and you don't do the maintenance on schedule, and you don't take it to the proper mechanic, thinking, oh, I saved few hundred riyals here, and I did some shortcuts there. I didn't do as per the intended book says, because I know better, that you'll be able to save few hundred riyals, but 4 or 5 years, 2, 3 years down the line, you're gonna end up maybe shelling out tens of thousands of riyals to replace an engine. Financial terms, so here we come to the terms. There'll be a lot of terms definitions here. Accounting, so when we talk about accounting, a principle that we utilize in accounting is called the accrual-based accounting. What does that mean? Accrual-based accounting, this is the common way in which we utilize accounting, is a method of recording accounting transactions for revenue when earned and expenses when incurred. What does that mean? If, for example, I sold you an AC. I sold you the AC today itself. And you told me that you're going to pay me in 1 week. I sold you the AC. The AC, I sold it to you for 1,000 riyal. The actual cost for it for me was 800 riyal. I must have generated a gross margin of 200 riyal. So this expense, if you're going to be paying me in 1 week, when do I recognize it? When do I say that I have made a profit of 200 riyal? Can someone answer me?
After a week when you receive the cash in your hand.
No. This is what accrual-based accounting is. Accrual-based says recording accounting transaction for revenue when earned and expenses when incurred. The revenue, I have already incurred the revenue. The fact that I didn't get paid by you is something else. For example, in the same example itself, let's say that 800 riyal, which I told you I spent, I also have an agreement with a supplier, and I told him I will pay you after 1 month even. So if you are saying like that, if you're linking it to cash flow, it means that in 1 week from now, I will say I have generated an income of 1,000 riyal, but no expenses, because the time of payment for the expenses to the supplier will be after a month. So after a month, I would have generated a negative 800. So to level things out, accrual-based accounting says that you record transaction for revenue when earned and expenses when incurred. It has absolutely nothing to do with the cash flow. And what does it mean, revenue when earned? Revenue is that when the transaction is done. In the case of material supply, it is when you deliver the material. In the case of contracting, it's when you conduct the service, and so on. So a key advantage for accrual basis is that... Tell me, Ammar. Please raise your hand if you want to.
Sorry.
Yeah.
Just please explain this accrual accounting again.
I'm coming, okay? So the key advantage of accrual-based accounting is that it matches revenues with related expenses so that the complete impact of a business transaction has been seen with a single reporting period. Again, I say, I'm selling mobile phones. I go and I tell you the price of this mobile is 3,000 riyal. You tell me, fine, bring me one. The cost for it to me is 2,000. I take it, if a non-normal thing, that the cash happens with the transaction. I go and buy it from Lulu for 2,000 riyal. I come and I give it to you on the same day and you pay me 3,000. So if that case, a simple transaction, I have made a profit of 1,000 riyal today, okay? The other scenario is that I do the same. I go to Lulu, I pay on my credit card, and the credit card will charge me only after 1 month. And I come and I sell it to you and you will pay me only after 1 week. Accrual-based accounting says that the revenue, the profit of 1,000 riyal is already recognized in my book today itself. This is what it means, because I have already incurred the cost. What does that mean? It means that, let's say I already bought it on a credit card, okay? And I came and you didn't buy it from me. That doesn't cancel my liability. My liability is still there. Similarly, the profit which I recognize is already there, whether you paid it or not. Let's say you didn't pay it, but you gave me a check against it. You are still liable for it. So I can take you to the police or whatever. So accrual-based accounting, it means that whenever a transaction happens, let's say you have an open, it happens to many of you guys operating in the business. You have an open credit with a certain store up to a certain 10,000 riyal of material, okay? You go and you buy from that store, you collect from that store. Let's not put collect from that store. You collect from that store cables and tools and whatever, and your bill comes 5,000 riyal, okay? The moment you do that, you are already liable for 5,000 riyal. Whether you pay it next month, you pay it after a year, you pay it in 2 years, you already incurred an expense in your business for 5,000 riyal. So I hope that clarifies it. So this is how all accounting is done. It's done based on accrual-based accounting. It's not done based on the cash transaction. And because you are already liable for that, irrespective whether you are paid now or not. The double entry bookkeeping in an accounting is a system of bookkeeping so named because every entry to an account requires a corresponding and opposite entry to a different account. You know what's debit and credit. Debit is that when you go and debit and put into some account. Credit is that you take from account. Double entry bookkeeping, accounting works on the principle that whatever is removed from a certain account should be put in another account. What does that mean? Let's say the company's cash assets when it starts here, typically when you start a business, you started with a minimum amount. Typically it's 200,000 riyal. So that we create an account for it, this 200,000 riyal. This 200,000 riyal goes into salaries, goes into buying equipment, goes into whatever. So double entry bookkeeping is that when I credit that base account of the company holdings, I am debiting another account. Let's say I credited this and I bought equipment. I debit the equipment and I credit the physical amount of cash. So unusually this is done. That's why we do the account balancing, because everything should be traceable from point A to point Z. So this is accounting. That's why when they are balancing the accounts, accountants do all of these measures to show how the transactions happened from A to Z and how it was recognized. Financial accounting, we will be coming into covering these as we move along. Financial accounting, you've heard for the term certified financial accountant, certified management accountant, CFA or CMA, and so on. So what's financial accounting and what's managerial accounting? Financial accounting refers to the aggregation of accounting information into financial statements, mainly for external use. What is financial statement? A financial statement, there are different types of financial statements which we're going to be identifying. But these are usually to a minimum. For example, in Qatar, you are supposed to provide an audited financial statement of the company by the end of the year. Financial statement is usually for external use. So here you submit it in the end of the year to show the government how much money you have made or lost, how you spent your capital and so on, okay, and how much tax you're supposed to pay. So it's called financial accounting. Another use for the financial accounting, when you want to go and apply for a loan, they will ask you for your audited financial statements so that you understand what's the health of your company, how much profit is it generating. If I'm going to give you a loan for 1 million riyal, will you be able to pay it? Is your business healthy, yes or not? So this is, again, this is another use for financial accounting. So we use it for taxation. If I'm a publicly listed company on the stock market, there are even more stringent requirements on financial accounting. Those of you who buy stocks or heard of stocks or are involved in stock know that at the end of each quarter, the company publishes its financial statements. Okay, they publish it not even annually, they publish it on a quarterly basis. And now you can go to any public listed company, even in Qatar. You can go to Ooredoo or Qatar Airways, go to their website, and you can download the financial statement for the last quarter. It shows how much the company has generated money, how much it has generated losses, what expenses they had, what's their profitability looking like, what's their gross margin, what's their net margin, and so on. So financial accounting is the accounting science of aggregation accounting information into financial statements for external use. This is one. So this is for formal purposes. Managerial accounting, on the other hand, refers for internal processes used to account for business transactions. What does that mean? When you go to your accountant and you tell him, my colleague, look, I want to know how much you have been paying for the last 3 years for the rental of cranes. Why? Because I'm thinking of what will be the impact if we buy a crane rather than renting it out. So they will go and dig into all the records of the crane rental companies and they generate for you one financial report. So this is for internal use, and this is what's called managerial accounting. You can use it on any topic you want. For example, you can find the profitability of a certain project. How much did we pay for the renovation of the hospital last year? They will come and generate a report. So these are internal processes to account for internal transactions. Majority of day-to-day uses for FM is grounded in managerial accounting. We deal mainly with managerial accounting, not financial accounting. Financial accounting, we deal with it, of course, because at the end of the year, you have to submit your documentation and you have to understand how much money you made and lost as a company. The cycle of management decisions. Management decisions happen by planning, directing, and controlling, and looking into what business value we add. A very important tool in dictating managerial decisions is accounting. As I said, if we are a for-profit organization, in the end, it happens, and the important is how much money we are generating, what profitability we are making. And if we're a non-profit organization, even charity organizations, we have a certain budget. And the way we utilize our funds is going to be subjected to scrutiny. We have a commitment towards those who are donating and so on. So accounting standards, there are general accounting standards. Accounting is one of the oldest professions in the world, accounting in organizations. Before there was quality control, before there was specific sciences on facility management and so on, there was accounting. Ahmad Abdul Rahman, financial statements are not confidential. They are confidential, but depending. If it's a public organization, then no, it's not confidential. If it's a publicly listed company, it means that listed on a stock market, then it's not confidential. If it's a private business, yes, they are confidential, but you share them with the authorities. You're supposed to share them with the authorities. Every organization registered in any place in the world is supposed to share their financial statements with the government by the end of the year. This is my answer to Ahmed. So as I was saying, that accounting is an old principle. So think about it, thousands of years ago, even with simple merchant, he used to put how much money he bought his things, how much he sold, and it started as simple as that, and then started going and evolving. In order to make sure that everyone is speaking a universal language, there are general accounting standards. Okay, there are two main accounting standards globally. Okay, so the accounting standard is how do we recognize the revenue? How do we recognize? So, and the question which I mentioned earlier is that when do we recognize the revenue? At what time? What does it constitute? And I answered is that we recognize revenue upon delivery, for example. So this is a universal language across all businesses. An accounting standard is a common set of principles, standards, and procedures that defines the basis of financial accounting policies and practices. Accounting standards improve transparency of financial reporting in all countries. So it is utilized by governments and to understand how can you recognize profit, what you do with the profit. And it's a common language. It's a common language between the organization and the bank, between the organization and the stockholders, between the organization and another organization that's going to merge into it. So to make sure that we are all talking the universal language. So in the US, we have the General Accepted Accounting Principle, GAAP, okay, formed a set of accounting standards widely accepted for preparing financial statements. International companies have another thing which is called the IFRS, which is the International Financial Reporting Standards, which are set by the International Accounting Standards Board. In Qatar, we follow this, the IASB and the IFRS. Okay. Some companies in the States, public listed companies who are having international operations, usually every quarter produce their financial statements in two formats. One that goes with the American ones as per the GAAP, and one for their international one, which goes as per the IFRS. To look into the detail of it, so chart of accounts is a listing of all accounts used in general ledger of an organization. So in an organization, usually we start by creating an account, separate account for everything. What does an account mean? So for example, if you look at an example here, is that there is the cash account. It means how much money I have in all my banks, or maybe in one bank. So this is a cash account. Okay. Accounts receivable. This is a separate account. What's an accounts receivable? It means that how much invoices have already been approved and are due for collection. This is a accounts receivable. An accounts receivable is an asset. So it is a liquid asset, but not as liquid as cash. Cash is a very current asset. We have current assets and fixed assets. Current assets, by definition, are assets that can be liquidated and utilized in less than 1 year. Okay, fixed assets are assets which you cannot be liquidating them within 1 year. So, for example, cash is the most liquid of assets. Sometimes of stocks are current assets, not all of them. Let's say if you have a fixed asset with the bank, let's say it's not a current asset. Maybe it needs 1 year for you to unlock it, and so on. Equipment is a fixed asset, which maybe you cannot liquidate it. So this is the thing. So the chart of accounts is a listing of all accounts that you use in a general ledger of an organization. Now everything is done by software, so things are much easier. The chart is usually sorted in order by account number to ease the task of locating specific accounts. So you see how the different things. We have the cash as assets. We have lab equipment as assets. We have insurance as assets. We have real estate as assets. We have accounts payable as liabilities. So accounts payable is the opposite of accounts receivable. So what does that mean, accounts payable? If I am having an agreement with, I said, that supplier, for example, in which I have an agreement that I will take material and I will pay him after 90 days. Okay, it's a common practice here, or 60 days. The moment I have the material delivered to my store, okay, it becomes as an account payable. It becomes recognized, all right? Unearned rent, and so on. So different things. So usually wages is another type of account under expenses. Someone has a question? Yeah, Sheikh.
I wanted to know, when you mentioned this as accounts, so does it imply the bank accounts? You mean like so many accounts we have in a bank?
Accounts doesn't mean the bank account. The bank account is one of them. Accounts is that under which you are grouping the things. You are doing trading of mobile phones and of AC equipment at the same time. You can keep a separate account for each one of them. Account, it means that it's a collection of, how do I say, assets, liabilities, or things like that in which you group your things. You look at this, for example. So this is accounts receivable, lab equipment. It's a separate account for you to do the transaction which you want to do. For example, you are renting rental of equipment. You can keep it in a separate account, equipment rental, depending on the organizational needs which you have. You are aggregating your expenses or your income in a certain way. That's how it is.
Okay, so yeah, it means that these accounts are within the company only, within the organization only, that our finances maintain.
Why you look at it, no? Cash is an account. Equipment is an account. Unearned rent is an account. Fees earned, revenue. It's self-explanatory. It's not something regarding your all your bank accounts can be a separate account. Account description ID, same like cost center, yes. So a cost center is an explanation of an account. So you will have usually an ID here, and they tell you, for example, book it on this cost center. You are right, Ahmed. So usually in some companies, okay, when you have a job, they will open an account number for you. And this account number will be for that specific job. Let's say you are replacing chillers on one hotel, and they tell you keep the number 2204. So whenever you're incurring an expense, you are putting under 2204. And that will be the expense account for which you can see that. Ledgers. So ledgers contains all the company's accounts with account balances. So this includes the accounts with the accounts balances. So again, we look at it. Assets, cash, trust checking account. We have year to date minus so and so. Liability, revenue from movies. Revenues, let's say that this is, I don't know, this is for a hotel or a touristic place maybe. And you see you're segregating the revenue from where you got it, for you to have visibility. Again, this is part of managerial accounting. Not all companies. Some companies want to know exactly each maintenance job. Like I mentioned, let's say the replacement of a chiller will have an account number. Other companies maybe say, no, we don't need for each and every job to know it, but we will put all of these under a general account, which is for maintenance. Okay. So in this case, for example, revenue coming from movies is put in a separate account. Revenue from bar, revenue from breakfast, revenue from dinner, revenue from golf, revenue from telephone calls, and so on. Revenue from cable TV. This is for a hotel, I think. So this is the revenue. We're keeping them in separate accounts. So the accounting ledger is all the company accounts with the account balances. Trial balances, remember when I said is that double entry accounting. Okay, this is a more detailed way of it. And it says companies compare the total debit and credit balances of all accounts to ensure that they are equal. So accounting, whatever you spend. Yes, Muhammad, tell me. Muhammad Najjar.
Yes, doctor. Regarding for the accounts receivable, is it the cash considered as accounts receivable? Like if I pay directly for the services, is it considered accounts receivable, or if it's like a debt, like I gave a service and I have around like 30 days of period to pay?
This is accounts receivable. Accounts receivable, it means how much money you have in the market, in a simple way.
Okay. Thank you.
This is what's accounts receivable. And it's considered as an asset. You can say that accounts receivable. Okay, I have an accounts receivable in the market for 5 million riyal, 10 million riyal, and so on. So this is an asset for you to collect.
Yes, thank you.
All right. So as I said, the accounting and the trial balance. So accounting, in the end, we are balancing it out. So here, we are putting it? So this is the account, okay, debit and the credit. Okay. Owner's equity, it means what enter the owner's equity. Owners put, for example, $80,000 into a business. They have done a sales of $10,000. So total in this has $90,000. How did these expenses go? We have done purchases for $15,000 for us to reach this sale. We have got equipment for $20,000. We have an accounts payable. We constructing the manufacturing plant and so on. We bought furniture for this. So this is always the trial balancing. We are always making sure that whatever is in equals to whatever is out. Accounting cycle. Accounting cycle starts by identifying transactions. So this transaction is it an expense? Is it a revenue? Is it a cost? A recording entry journal entries, post ledger entries, and then you get the unadjusted trial balance. You adjust them, adjust the balance, and you get official financial statements, and then you close your books for the year. So the frequency of accounting changes from one company to the other. Some companies provide the trial balance and the financial statement on a monthly basis, and they compare the budget to the actuals on a monthly basis. You compare the deviation. Some do it quarterly, but at least some never do it, but at least you are supposed to do it by the end of the year so that you can present these financial accounting data to the government. Budgets, what is budgeting? Budgeting is, and why do we need budgeting? Budgeting is about a way of predicting, okay, what transactions you're gonna do in an upcoming period, okay? Whether it is, usually budgets are made for a 1 year period, the general budget, and in it we are anticipating how much sales we are going to make, how much profit we are going to make. Based on this sales, how much is going to be our anticipated revenue? what are the expenses that we're going to do to achieve these sales? How much do you think I should pay in marketing? How many people do I need to hire to achieve this this budget, and so on? Or maybe let's say next year, okay, I see it as a tough year. I see that my sales is going to go down. I put myself a lower target or a same target or whatever. So based on that target, how much do I see my expenses happening? And it's a way for me to have visibility and to be proactive rather than being reactive, okay? So why budgeting is important? Because it gives you control over your money. As we mentioned again, regarding quality, regarding energy consumption, anything that you want to improve, you need to know where you are now. You need to know how much. Imagine if I don't have accounting. I don't know how much. Even sometimes we have accounting and we don't know in detail how much each project is profitable. So I gave an example previously. Let's say if we were previously recording everything to be dumped into one account for expenses which we are using for maintenance, maybe I will not be able to pinpoint in detail if this project is profitable, yes or no. So for me to understand profitability, then I will, for example, say, no, each project we need to consider separately and to record it accordingly. So when we start by budgeting, it gives us better control over money because we are measuring it and keeps us focused on money goals. When we set a budget for a year and then based on the year set a budget for a month, then everyone's focus will be on meeting the budget. And usually what happens by the end of the month, we set the budget, the budget versus the actual, and we measure the deviations and we do an analysis. Why are we deviating? Maybe my sales is lower. Okay, fine. My sales is lower is because of this. I need to have a plan for me to improve the sales. My net profitability is lower because we incur a certain cost and so on. So it makes me more proactive. So it raises awareness on what's going on with the money, helps organize spending and savings, decides in advance how money should be spent, enables to save for expected and unexpected costs, provides an early warning for potential problems. So it's like with the energy consumption. If you're measuring something, is the budget like a ledger? No, the budget is not a ledger. Ledger is a list of items. Budget is, this is the ledger. Ahmed, this is a ledger. This is not a budget. This is just a ledger mentioning the accounts and the balances. It has nothing to do with the budget. Does it show how much is your anticipated sales? Plus a ledger, it talks about for on a certain date. On February 28th, this is what we have. This is my ledger. It doesn't say my budget for that day is so long, so much. Something totally different. A budget is for a certain period. Okay, we will see some examples. I'm expecting to have this much revenue. I'm expecting to have this much cost. I'm expecting to have this much profitability. This is a budget. Okay. The way we create budgets differs. There are different ways to handle it depending on the organization and the type of the business. Yes, Ammar.
Budget is like what we can say forecasting.
Yes, it's a forecasting.
Oh. So we can like forecasting the expenses, the turnover, everything.
Yes.
Okay.
It's an estimation. You work in projects, Ammar?
No, I didn't work in projects before.
See, whenever you're doing a project, you're always making an estimation, as we will call it. Even for a business, you're making an estimation. I'm estimating that next year, now this year, I may, let's say I'm starting a new business, okay? Forget that I'm starting a new business, and this business will be the trading of cell phones, okay? I think that for me to be able, I have a good source of cell phones. I will be able to buy each cell phone at 2,000 Riyal and sell it at 2,300 Riyal, okay? I believe that I can sell 100 cell phones per month, okay? So I'm anticipating, and I will have expenses of the salary of the workers. I will have expenses of the setup of the company. I will have expenses for the rent, and so on. So this is how I create my budget. So my budget for next year is gonna be this much. Based on how much I'm expecting to sell, this is my cost. Maybe I will end up with a negative figure, and maybe it's okay. Most startups will not generate money for years, okay? So it's not about that, but it's about knowing if you are within the budget, yes or no.
So this is can be included like in with a feasibility study. If you are planning for any project.
This is, I'm trying to make it related to a feasibility study. A budget is not a feasibility study, but a feasibility study is sort of a
feasibility study.
It's
a part of feasibility study.
No, feasibility study is sort of a project-wise budget. Let's put it this way. Feasibility study is a part of a budget, is how much you anticipate. In a feasibility study, you are making a budget for a project. Let's put it this way. The budget for the company, it includes all the projects in that company. So it's an estimation of future revenue, future expenses. Okay, the budgeting approach, we have an authoritative approach, which is what we call a top-down budgeting. It means that the budget is dictated from a top level down the lines. So, and it's a budget in which senior management develops a high-level budget for the company, authoritative approach. So in this case, like the company will come and say, okay, next year I'm expecting a revenue of 50 million riyal from you, okay, at a net margin of 10%. So it means I need a net profit of 5 million. This is your budget, okay? You have to work within it. And then you go down and you have to see how much people you hire, how many people you fire, and so on. This is set from the top to the bottom, okay? Combination approach is a negotiated publishing, is a combination of top-down and bottom-up budgeting method. So we have this authoritative top-down. On the other hand, we have the bottom-up. The bottom-up where the company will say, look, we cannot do a 50 million next year. We can do a 45 million, okay, at a net profit of, let's say, we will make only 2 million net, and we send it to the top. Combination approach is a negotiating approach. It's a combination of both top-down and bottom-up budgeting. So we negotiate between the two. Participative approach is a budgeting process under which people, those impacted by a budget, are actively involved in the budget creation process. So it's like a company-wide approach where, okay, we go to engineering, we go to this and tell them, okay, how much you're going to be needing next year, and so on. So different organizations have different approaches, but usually it's a more democratic way because an authoritative approach is not really working. But again, in the end, management and the shareholders will have an upper hand on it. There are different budgets. There's an operating budget and a capital budget. Okay. Operating budget is the company's projected revenue and associated expenses for an upcoming period, usually the next year, and it's often presented in an income statement format. We will see the income statement as we move ahead. A capital budget, so this is for the operation. We say that we're going to do this, we're going to do that. There's a difference between capital costs and operational costs. I'm not sure if you've heard the term CAPEX and OPEX. CAPEX is capital expenses. OPEX is operational expenses. Okay. What is OPEX? Is that, for example, operational expenses. I need to pay rents, I need to pay salaries, I need to pay suppliers. This is called operational expenses. Capital expenses, and why this is done, I will tell you now. Capital expenses is that what I'm buying capital equipment. Let's say, for example, I am setting up a new factory. I'm buying new equipment. Why there is a separation between the two? Because we need to understand how profitable the business is. For example, if I'm having a profitable business, okay, let's say I manufacture mobile phones. Okay, there is an existing factory which I bought. I manufacture mobile phones. I am able to produce a mobile at a cost of 3,000 riyal, and I'm able to sell it to the market at 3,500. I'm generating revenue. Okay. But let's say by the end of this year or next year, I'm planning to upgrade my equipment. So if I'm planning to upgrade my equipment, let's say when I'm selling for 3,000 and 3,500 and buying at this, I am able to generate $1 million by the end of the year. Okay. So I am generating a revenue. Let's say next year, I'm planning to invest in a new factory, which will increase my production cost. But that new factory costs me 10 million riyal, $10 million. I cannot put that 10 million as part of my operational expense. Because let's say the next year I generate 1 million from selling the equipment and I put down 10 million as a capital expense, that doesn't mean that I'm losing $9 million. So the investment which I make in capital expense is dealt with separately so that I'm able to differentiate between my capital assets, okay, and my operational income. So capital budget is the process which determines and evaluates potential capital expenses or investments. Capital expenditures are the funds used to acquire or upgrade a company fixed asset, such as expenditures towards property, plant, or equipment. Again, let's say I can go and today I'm generating a 5 million riyal income, and then I decide, okay, look, I'm gonna buy a crane. Okay, the crane costs me 3 million riyal. It doesn't mean that I only generated 2 million. I have an asset. I have now an asset which is for 3 million riyal. Capital asset is an asset that has a useful life longer than 1 year and is not intended for sale during the normal course of business. So, for example, if I'm buying stock, it is like an asset. If I trade mobile phones, I bought a lot of for 20,000 riyal. That's an asset, but that's not a capital asset because my job relies on selling it. So this is the difference between capital asset and a capital budget and an operation budget. Another term to consider in budget, fixed budget is a budget that doesn't change due to any change in activity level or output level. So normally we have a, yes, Sheikh.
So in this budgeting, we don't use the term that used to before account receivables and account payables does not come in picture during budgeting, right? They are the actual ones, and budgeting is forecasting.
There is something called cash flow forecast in which you utilize this. It is part of, it can be part of the budget, but don't confuse yourself with it now.
Okay.
Okay. Usually we do a cash flow budgeting, but the regular budgeting talks about the income statement. We will be covering more details as we move along. Okay. It's important that you cover the basic principles at least now. A fixed versus variable budget. So a fixed budget is a budget that doesn't change due to any change in level, activity, or output level. A variable budget is a budget that changes as per the activity level or production cost of units. Normal companies will have a fixed budget. A variable budget is budget linked to output of production. Let's say in a plant, a production plant, you have a variable budget. Why? Because you have fixed costs. So fixed costs are costs that do not vary with output and often include rent, buildings, machinery, which are called in general overheads. Variable costs are costs that vary with output. So normally in a manufacturing setting, you will have a basic fixed cost like the rent of the plant, the salary of the secretary, the salary of the manager, and so on, which will not change whether you produce 10,000 units or 100,000 units. And there are other variable costs that will change. If I produce 10,000 units, I'm gonna buy material only for these 10,000 units. Whereas if I'm gonna make 100,000, I'm gonna buy more material, so my costs will increase. So this is what we call fixed versus variable budgeting. So there's a fixed cost, which is the same irrespective of the output level, and you have a variable. And then when you add them, you have this total costs. Always the fixed cost is there at the baseline. Variable costs may include wages, utilities, materials used in production, and so on. Budget period, the most common budget period is a year, but there are other periods. You can create a budget for a month, you can create a budget for a week, you can create a budget for 5 years. Okay, budget period is a specified future period of time over which revenue and expenses are estimated. Again, you see the same thing happening. Revenue, how much you generate money, expenses, how much you spend, and estimated budget is about a budget estimate. That's why you usually do a review on a monthly or quarterly basis to say, okay, how much we have spent and how much is the actual. How much we anticipated. We anticipated that we will sell for 5 million riyal this month or this month, but we actually sold for 4.9 or 4.8 or 4. Why did that happen? How does that affect us? How does that affect the business? Maybe we should hire more salespeople. Maybe we should change the sales team. Maybe we should change the business, something like that. So that's why you are continuously measuring and assessing where you are versus where you were supposed to be. Budgeting is usually done for short, mid-term, mid-range, and longer-term period, a month, a quarter, and are usually observed. However, budget period can vary with each entity. As I said, a rolling budget is a continually updated to add a new budget period to as the most budget period is completed. A rolling budget involves the incremental extension. By doing so, it has the budget that extends 1 year into the future. So a rolling budget is a year-to-year budget. Today is August. Today is August, July 11. Okay, a rolling budget is that it gets updated and reviewed. Like I will have a budget for 1 year ahead, from July to next July. This is a concept of called a rolling budget. Usually we have a 1 year budget. It's a more common way. We'll have like a budget for 2020, a budget for 2021, and organizations decide to review it based on this. Like we review it on a quarterly basis and a monthly as well. Other concept of different budget methods. We have a zero-based budget. A zero-based budget is prepared from the scratch without considering the budget of the previous year. In a traditional budgeting method, the one on the right, you take the last year, how much we have achieved, okay? Then you do changes based on inflation, consumer demand, market situation, and so on. So last year you sold for 5 million riyal. This year you find that there is more demand for your product, and you saw it increasing throughout last year. Then you anticipate the same and you say this year we're going to close at 6 million riyal, but there is inflation costs and so on. The profitability percentage wise is going to be less, but we're going to be doing more and so on. This is the traditional budgeting. Incremental budgeting is prepared by making changes in past year budget, considering the inflation factor, quick and easy method of preparing budgets. So the incremental and traditional, you are basing it on an old budget and you are changing to it. A zero-based budgeting is a more, how do I say, more aggressive approach, and usually this is done in periods where you need to really re-evaluate the business. You say, and we had it done this year, for example, due to the difficult situation, change in management and so on. Management came and said, okay, you do a zero-based budgeting. What does a zero-based budgeting? Is that rather than you base your expenses at what you had previously, go and scrutinize each and every expense that you have, whether you need it, yes or not. In a traditional budget, to say, okay, last year we paid for insurance 1 million riyal. This year, okay, we didn't change the assets, so we're going to pay another million. In a zero-based budget, you go and assess, oh, do I really need an insurance? If I need it, for what assets do I need? How much do I need to pay for it? Rather than relying on all figures, let me call the companies again and ask for new quotations. This is zero-based budgeting. Activity-based budgeting is a budgeting method where the budget is prepared after considering the cost drivers. It does an in-depth analysis of activities incurring costs. So again, it is another way of scrutinizing your costs. My activity, purchase of so and so product, I go and link everything related to that, and I try to create a budget for it. General budgeting guidance. Again, we go into mentioning why important it is to have budgeting. When you are looking knowledgeable about budgeting, your ability to manage the probable cost increase degrees for a different given budget period, determine the impact of capital needs on the operating budget, manage and control costs, support the company core business. I've been telling you or talking about this. Budgeting monitoring. When you are monitoring the budget, you are seeing, okay, am I able to maintain the budget? So I came and I talked to my maintenance team, and they said, okay, next year we will be able to do sales of our maintenance service. Let's say I maintain chillers, okay? They estimated that they're going to be able to do 10 million riyal in sales and contracts. And these contracts, they will be able to get them at a 25% gross margin. It means that they will generate 2.5 million riyal, out of which the general cost, whatever. So I will end up with a net, let's say, of 1 million riyal. I go and say, okay, this 10 million which you put for next year, I'm going to divide it for you over the next 12 months. And I'm going to be monitoring you every month if you are achieving your target, yes or no. So I achieve it for this month, and I get year to date, and as I move to around. So this is called budget monitoring. And when you do budget monitoring, you're demonstrating accountability. You told me you're going to be selling for 10 million. Show me. Ensure an efficient and effective use of resources. When you calculate your budget, you're calculating your expenses based on a certain revenue. If you are not generating this revenue, it means that your expenses are not justified. If you are a business which is generating 50 million riyal, you're supposed to have a certain kind of expenses, a certain size of office, certain size of salaries. But if, let's say, next year you have budgeted for 50 million and then you didn't even achieve half that revenue, it means definitely you have to do something regarding your costs. So budgeting monitoring helps you make sound business decisions and allows you to take remedial action when needed. As I mentioned previously, maybe you need to remove some people, maybe you need to do some changes to the way you're approaching the market, maybe you need to hire additional people to do marketing, or so on. Measuring is knowing and seeing and establishing a baseline. So budget closeout, at the end of the year, budget closeout is held. It can be a simple or complex process that varies on the organization. So the process norm requires the manager to coordinate with the finance department. I'm sure many of you will have the experience that towards the end of the year, there will be a big push from everyone to close the budget. We're trying to see what expenses we still have in the market. The finance will come and tell you, look, if you don't put and record these expenses that you have with your suppliers, we will not be able to pay them until January next year, because they need to close the financial year and they need to close all the accounts related to that year. They need to close all the expenses and all the revenues generated within that year. Now we go into financial statements. How much is the time? Let us take a 5-minute break and come back in exactly 5 minutes at 8. Okay. Hi guys, back from a short break. Now we talk about financial statements. You can hear me?
Yes.
The financial year is January to December. Yes, Sheikh. Previously it was not. Previously we were supposed to submit it, I think, till March, I think. Yeah, it's from January to December, the financial year. Okay, categories of financial statements. You have internal income statement. So okay, the basic financial statements are three types. Okay, they are the income statement, and they are the balance sheet and the cash flow statement. We will come into each one of those one by one. The categories usually of financial statements. So financial statements is what's generated by accounting. There is an internal income statement. It's a financial document used to gauge a company's ability to generate revenue and profit. External financial statement. So you can generate an internal statement. External financial statement is the one which we said for external use, which is prepared according to the IFRS or the GAAP and the FASB, which we mentioned earlier. Audited financial statements result means financial statements certified by an auditor as showing the true and fair view. So they can be internal or external. Usually, many organizations, they aim for them to align the three. When you submit, so what happens when you are doing a financial statements is that you prepare your financial statements, and then you have an auditor. Who is the auditor? Like KPMG or Ernst Young or many of those. The big fours are one of them, but there are many others. So what do they do? What does the role of the auditor? The auditor's role is to come and confirm that you are recording your financials as per the standards in which you're supposed to do them in this part of the world. So they come and verify that. They come and verify that, yes, what you are saying in your income statement is actually done as per the international principles, and that you are recording it correctly. They will come and audit you. They will come and verify that the data that you have put there is correct. Okay. Audited financial statements will have the following outcomes. Qualified opinion. So the auditor will come and put a qualified opinion suggesting that the information provided is limited in scope and or the company being audited has not maintained relevant accounting principles. So qualified opinion is a bad thing. You are always aiming to secure an unqualified opinion. Unqualified opinion where the auditor comes and says is that it's the thumbs up. It means that you have done your financial statements to the relevant accounting principles and represent the company's account fairly. So this is an unqualified opinion. So this is what you're aiming to get from an auditor, to have an unqualified opinion. Once the auditor approves your audited statements, then you can go and submit them for the governmental authorities, and then they approve them. And that's why banks will ask for audited account statements. They go and ask for an audited one because they want to verify that someone else has checked them and that they meet the required standards. The type of financial statements, income statement. As the name says, is that the income statement, when we mentioned previously regarding the budgets and all, usually we do in the budget, we do mainly the income statement. So the income statement, it shows us that how much sales or revenue we have generated, the revenue, how much expenses we have incurred, and how much is the income. as simple as it says, and then the net income, how much it is. So for this company, they have generated a revenue of $500,000, out of which they have had several expenses. Their final income was $91.5 thousand, and this is their net profitability. So this is called the income statement, or the P&L. You heard the term P&L, profit and loss statement. Okay, so this is the profit and loss statement. A statement of operations, statement earnings, profit and loss is a report revealing the financial performance of an organization for the entire reporting period. So an income statement mentions a period. It's not a screenshot of what the organization is now. An income statement can be for the year to date, from the beginning of the year till now. It can be for the period of 1 month. It can be for any period. You have to specify the period. Okay, you can specify it for the last 5 years or so on. So this is what we put, and usually the format is something like this. This is a simple one. I will explain it a little bit in details. Usually you start by putting the revenue on top. Revenue is means how much you're generating from sales or other. So this is sales revenue. 500, we have sold for $500,000. Other revenue, usually it will be like, let's say you sold some equipment or whatever. This company didn't have. Cost of goods sold. After the revenue, we come something. What's the difference between a gross profit and a net profit? You've heard the term gross profit and net profit. I will give the simple example. Actually, the easiest way to do accounting is for a trading business. I am buying this mobile at 3,000 riyal, and I'm selling it at 3,500. Okay. My gross profit per each mobile is 500 riyal. That's the gross profit. It means that I get a revenue of 3,000 here, and then the cost of goods sold, the cost is going to be, as I said, 3,000. So I get 500 riyal. But where is the but now? But this is not my net profit. Even if I'm having a simple business of just having a simple shop rented and I'm buying this, I still have to pay rent. I still have to pay salary. I still have to pay for electricity. I still have to pay for government fees, visas, and so on. So these are into the indirect expenses. These are called the indirect expenses. So the revenue, sales revenue, the cost of goods sold, and these are the other expenses. Accounting costs, advertising costs, bad debt costs, depreciation, we will come to that, employee wages, entertainment, insurance, so on, so on, so on, so on, so on. And I get these total expenses. And then I have something which is called the net. The net is, let's say here I had 500 riyal. Okay, let's say I'm selling each month 100 units. So I will have at the end of the month 50,000 riyal. But out of this 50,000, I am renting a store. I am doing all of this, and this cost me 30,000. So I'll have a net in the end of 20,000. I hope that this is clear. So this is the profit and loss statement. This is a main item in your budget and everything, and this is where everything is being measured. There's another type of statement, and I will see why this is needed. Someone open the mic? Yeah, Sheikh.
Yes, I wanted to know how about the terminology turnover is also used here. So like sales revenue is turnover?
It's turnover, yes.
So when we say a project has a turnover value of this one, means that is the total cost of the project.
Not cost, revenue.
Revenue.
Yes. So if a business, usually they don't say a project turnover, they say like a business has a turnover of 20 million riyal. It means that each year it will generate revenue for 20 million riyal. That's what the turnover is.
Okay. And then the net income will follow as you mentioned. Okay.
Yeah, and then there is the gross income, gross margin. It means is that a company is having a revenue of 20 million riyal and they have a gross margin on that 20 million riyal of 5 million. It means the projects themselves, they're generating 20 million and out of that they have a profit on the projects for 5 million. But then you have the general, what we call them, the overheads, the office, the manager in the office, the indirect expenses. Here we talk about in this part, we talk about the direct expenses, the cost of goods sold, direct expenses related to the item. So if you're doing the project, the people on the site, they are considered direct expenses. The material you buy at the site is direct expenses. Here you have the indirect expenses. Indirect expenses will be the rent of the head office, will be the salary of the manager sitting in the head office, will be the salary of the accounting team, will be the marketing costs, will be all of these, what we are calling them overheads. All right. So another thing that another financial statement is called the balance sheet. So balance sheet is a statement of the asset, liabilities, and capital of a business at a particular point in time, detailing the balance of income and expenditure over the preceding period. Okay, a balance sheet. So whereas the P&L statement is period-wise. So in this month, this year, this day, how much revenue I generated, how much expenses I incurred. A balance sheet is a screenshot at a particular point in time. What does this company own? What does this company have liabilities in the market? So it's not related to a period, it's at a particular point in time. So there's a company here called Teddyfab Inc. It has a balance sheet and we are saying the period of it. So December 31st, 2100, for example. A balance sheet is usually divided in this format where you have total assets on one side and you have total liabilities on the other side and total shareholders' equity. So the assets, it means that what the company owns, what are the assets of the company. Liabilities, what the company has dues for it in the market and towards other people. And here, what is the shareholder equity? It means that the company is dealt with as a separate body. So this body is also liable towards the owners. So if I made a business and I generated 1 million riyal in revenue, which I can pull out, not operational expense, it will go into the shareholder equity. Let us look into the example of it. Sometimes I go and I explain more, but this will be beneficial for you in life. It's not only related to the exam which you're going to take. So assets and you're not really necessary, some of them, to know them, but I'm just covering the topics. So here you put the assets. Usually assets are sorted out from the most liquidable to the least liquidable. What does it mean liquid? Cash and cash equivalents are the most liquid asset. Accounts receivable is a second thing. Inventory, how much items I have in stock. I'm selling mobile phones. I have a stock of 15,000 riyal of material. It's mentioned there. Prepaid expense. What does that mean? It's an asset. Let's say that I have already went and in my rental condition, I had an agreement with the landlord that I will pay him 2 years in advance, or I'll pay him the 1 year in advance. So I have a prepaid expense. It's an asset in my favor. Investment, I have them here. So the total current assets are $150,000. This is current. Okay. Then we go into the fixed assets. Fixed assets, land. I have land that's worth this much. Building and improvement, this much. Equipment, this much. Then depreciation, we will cover that. Other assets, intangible asset. What's an intangible asset? It's an asset which is intangible. The most common one is the brand. So, for example, Coca-Cola's intangible asset as a brand is maybe much more important than its fixed assets because the brand is so much valuable. So we have total assets for this much. You see that in general, the assets should equal the liabilities plus the shareholder equity. So the 472. On the other hand, the liabilities, Again, we sort that. Accounts payable, we have suppliers to pay them this. Notes payable. Accrued expenses. Accrued expenses are expenses that are accrued which I have not been invoiced for. So, for example, I took material from a supplier. I have these accrued expenses which are not taken care of. Deferred revenue. Shareholders' equity. So this is what we got. This is the long-term debt. Same way I sort them here by the most liquid to the least liquid. Here also I sort them by the most urgent to the least urgent. Long-term debt is this much. Total liabilities is this much. Shareholder equity, it means that how much the organization is having money owed to its shareholders. Common stock is this much. Paid in capital, retained earnings, and so on. So the important thing is that they should balance out, and that a balance sheet is a screenshot of the company's assets and liabilities in a certain period and time. The third type of financial statement is the cash flow statement. Cash flow statement. So the first one shows, just a minute. The first one shows how much a company is profitable, how much the operations are profitable. Pointer options, clear, erase, all link. Okay. The second statement, the balance sheet, shows how much strong the company is in terms of its assets and liabilities. The third one shows how much the company is cash liquid. Cash liquid, how much the company can manage its own expenses. So you can be a very profitable business but are short on cash, and this happens a lot. It happens a lot in the market, and it happens a lot in startups. Startups usually they require and burn a huge amount of cash. Why? They might be very profitable, but they are growing at a pace and expanding at a pace in which they cannot finance their own growth. They have a huge demand. Uber wants demand in China, Japan, so on, so on, so on, so their operations is becoming, they don't have the cash. That's why they go to venture capitalists. That's why they go to the stock market to go and put the stocks of this company so that they can get cash to fuel their operations. So a cash flow statement reveals the cash inflows and outflows expressed during a reporting period. So for the year, the cash, we have received cash this much from the customers. We have paid this much for the stocks. We have paid this much for salaries. We have a net cash flow from this. We have invested some money of this cash, and we have received this money. We have received cash receipt, and we have invested this much. Cash flow from financing, we paid this much cash to finance. Net increase in cash over this period is 17,000. So we can see that the business can have a positive cash flow and be losing money, or can have a negative cash flow and can be making money. So it is irrelevant. So that's why we record it and measure it on a separate financial statement. A concept that was mentioned earlier and which is now called depreciation. What does depreciation mean? In a simple term is that when you buy a capital asset, let's say when you buy equipment which is used for production, okay, you pay for it 1 million riyal. It will depreciate over time. What does that mean? That depreciate? It will not always be worth 1 million riyal. The more you use it, the more it's going to be depreciating. Or sometimes it depends on the age. So if you buy a building, let's say, it will depreciate. If you buy a vehicle, it will depreciate, and so on. So depreciation is an accounting method for accounting the cost of a tangible asset over its useful life. And it's used to account for decline in value. Okay. Companies use depreciation, report asset used to stakeholder. So you report the asset used to stakeholder. For people who want to, sorry, I cannot see this, just a minute. For people who want to sell their business, the depreciation and the books help to see which time is best to reinvest in assets, help companies correctly report assets at their net book value, help companies generate tax savings. What does that mean? There are different depreciation methods, okay, and there are accounting rules which regulate depreciation. For example, just to give you a simple example, vehicles in Qatar are supposed to have a full depreciation over 4 or 5 years. I don't remember. But they regulate that, okay, if you buy an equipment for 50,000 riyal, you're supposed to depreciate it over the next 5 years equally in a straight line depreciation. So there are different depreciation methods. There's a straight line depreciation. It means that each year I depreciate it. So the depreciation, what do we have in the end? We have something that is called the cost, and then we have something that's called the salvage value. For example, I bought a crane. A crane cost me 1 million riyal. And I know that a 5-year-old crane, the 5 year down the line, I will be able to sell that crane for 400,000 riyal. So that means that over the next 5 years, this crane is going to be losing 600,000 riyal of its value. This 600,000 riyal, the way I allocate it in a straight line depreciation is that I take the 6,000 and divide it over the 5 years, and I will get these equal depreciations each year. So each year, as an expense, I will put the depreciated amount of the asset. So this is straight line depreciation. Another one is called double declining balance depreciation. What does that mean? Usually this is used to show that there is more depreciation in the initial years of you buying the investment. You see, for example, here it's 6 to 50, they're not equal, 4, and then as the asset grows older, it becomes less. Again, there's a science behind all of this, and it can help the company generate tax savings the way you utilize for your depreciation, because depreciation is considered as an expense. Finally, there is the units of production. When you link, let's say for production equipment, you can link the depreciation to how much units you produce. You are having a paper generating mill, and you are linking it to how many tons of paper you produce. So it can change like this. So these are the different depreciating methods. Capitalization versus expense. Expenses can be expensed as they incurred, or they can be capitalized. What does that mean? Expenses, there are certain types of expenses which you can treat as capital. So like, for example, rent. So rent can be considered as a capital expense. It will be treated differently than regular expense. The way it's recorded in the profit and loss statement is included differently. An important decision that you usually take as a facility manager is the lease versus purchase option. Okay, whether you are deciding to buy or rent equipment. Maybe some of you have faced that decision. I've mentioned previously the crane, the man lift, even the vehicles which you use in the company. Shall you rent or shall you buy? Okay. What consideration do I make? Usually over the long term, usually buying is cheaper than renting. That is known. It's cheaper to buy a car rather than to rent it. But renting provides flexibility. Let's say I'm not sure. Now I'm having 10 teams. Maybe next year I will have only 3. So rather than taking the risk of buying the equipment and keeping it there, maybe better I rent. Consider the life cycle cost analysis. Again, another important thing is the life cycle cost. If I'm going to, maybe it's more convenient for me to rent rather than to buy, and then to go through the trouble of maintaining it and so on. How frequently technology changes with this asset? Can we do it by project? Ahmad, what's your question? Ahmad Hakim, you have a question? Fine, I'll continue.
Sorry, you can hear me?
Yeah, I can hear you now. You were muted.
Okay. I just want to ask regarding the depreciation. Can I do it by project? Let's say I buy a crane and
I cannot hear you.
have 2 or 3
We
projects
lost
per year.
you.
So
What?
it costs me like We can do depreciation
Come
per
again?
project.
How do you
We
mean?
can, like I buy a crane, but like 1 million real, and I have 3 projects. So I divide the cost in 3 projects. So I depreciate it in 1 year.
Yeah, it can be. This is something related to the production. I think theoretically you can. Usually in accounting is that what you adopt as a principle you have to follow through. So the way you're depreciating it, so maybe you're linking the depreciation now to the hours of operation, and you are allocating it based on the hours of operation of the project. Yeah, it can be done. Why not?
It can be. Okay, thank you.
All right. So how frequently does the technology change with an asset? Some assets it's better than you rent, than you buy. Like you will find out that servers or things like that, rather than you holding liability. How long does FM plan to keep an asset? Cranes, for example, if I have a frequent use for it, or is it just going to be for 1 year? It happens a lot in FM when you go and take a big facility, and then you have to bring in man lifts, cranes, crawlers, and so on. So this is a decision to make. What are the finances options for purchasing versus leasing? So sometimes you get you have access to finance, and but sometimes you don't have access to finance. So that's why you decide to rent. So sometimes it's cheaper for you to operate, but that it means that you would be blocking, let's say, 500,000 riyal. You decide, no, it's not worth it. I'm just gonna, even if I pay more, I don't have the enough cash flow. I will just rent it. What are the tax benefits? Of course, there are tax benefits depending on the jurisdiction and the way you book your expenses. Pro forma statement is a statement in which certain assumptions and projections based on actual past transactions, pro forma income statement, pro forma balance sheet, and a pro forma cash flow. So you can create a pro forma. It's like the pro forma invoice. What does a pro forma mean? Pro forma, it means that an anticipated one. So what's the pro forma income statement for the next, for this project? We make a pro forma, sort of like a budget, an estimation. Pro forma balance sheet and a pro forma cash flow. Business cases, as facility managers, we usually are requested to provide business cases. So a business case is a justification for a proposed project or undertaking based on its expected commercial benefit. So we go and supplement a business case. For example, okay, now we are paying 1 million riyal every year for power consumption. If we invest 500,000 riyal, we will be able to reduce this 1 million to 700,000, and in less than 3 years we will be able to recover our costs, and for the rest we will be generating lower expenses. So a business case is intended to convince key decision makers of the merits of a particular course of action. If we do this, we get that. So a business case is created to help decision makers ensure that the proposed initiative will have value and relative priority compared to alternative initiatives. The performance indicators found in the business case are identified to be used for proactive realization of the business and behavioral change. So a typical business case would be, okay, we are renting, someone will come to you or to me, or you go to your, or you can go to your manager and tell them, look guys, every year we are paying for the rental of man lift this much, whereas the cost of buying the man lift is this much. If we buy one and we keep it, and this is the operational cost, this is the cost of hiring the people to operate it and training it, we will be saving money. So this is the business case, and a business case usually will have an executive summary. It means that it will say that this business case is about so and so, and it talks about the goal. The goal, for example, is to reduce expenses of the operational cost of the facility by reducing the electricity bill. Solution, we are proposing the utilization or the upgrade of the chiller from model so and so to model so and so. The costs involved will be this much as per this breakdown. This is the cost of the equipment. This is the cost of the installation. These are the benefits. The execution timeline is this going to be this much. and so on, and then you present your business case for approval. Can be a preventive tool for losing money. Yes, it can be a preventive tool for losing money. It can be a tool for you to generate more revenue. It's a business case. Yani come and present me with your case. Every day you go to your management telling them that things regarding suggestions. So this is the business case. So they tell you, okay, make a business case. They tell you, you go and tell them, look, business case cannot necessarily mean to generate money. For example, a business case can be, it's better that we buy our own man lift. Why? Because we are receiving complaints of our delay, because every time we need this, we go and to hire it in the market and for it to come here. So it makes more business sense for us to hire it and keep it on the premise, even though it costs more. So a business case have many facets to it. Can be just to present a viewpoint. Identifying costs and benefits. So there's something called a cost-benefit analysis. So a cost-benefit analysis. Someone has a question? Okay, I continue. So a cost-benefit analysis is a technique used to compare total costs with benefits using a common metric, most commonly monetary units. So a cost-benefit analysis, let's say I put an example here. Okay, the cost-benefit analysis. If you want to talk, please raise your hand. I can see that and I can tell you to come in. The cost-benefit analysis, let's say the purchase of a new stamping machine. This is an example which I got. Or let's say the purchase of a crane, the purchase of a man lift, the purchase of whatever, a pickup truck, a boom truck. Okay, so the cost of the cost benefit. So the cost will be this much, the installation will be this much, the increased revenue in this case will be this much, the quality increase in revenue because we're going to have less rejection, reduced labor costs, but it will have to have other cost aspects. So these are the savings or benefits, and these are the costs. The costs will be, you need new operator, you will pay for new utilities, new insurance, and so on. So this is called a cost-benefit analysis. The following analyses are part of the business case cost and benefit, best value, life cycle costing, or benchmarking. Capital investments and the time value of money. If you remember when we were talking about sustainability, we covered the concept of the time value of money. The time value of money in which we said that $1,000 in the future is less than the value of $1,000 now. So the value of money reduces with time due to inflation and other reasons. So money available at the present time is more than the identical sum due to the future due to its potential earning capacity. Capital investment analysis is a budgeting procedure that companies and government agencies use to assess the potential profitability of a long-term investment. So there are several tools. We covered the net present value. We mentioned that previously. The internal rate of return, as we said that, okay, if you give me 1 million riyal, I will give it, it will generate revenue for me after 1 year of 1,050,000. So the internal rate of return of that project is 5%. Payback period, how fast can I return my investment? If you go and tell your manager, okay, if you invest 50,000 in the purchase of a new vehicle, we will be able to save on rental costs, and the time payback for return will be for 2 years. After that, it will be savings. Benefit to cost ratio is a benefit cost analysis, and you can put it as a ratio. There are different ways to minimize risk in capital investments. So capital investments, they call sensitivity analysis or scenario analysis. Scenario analysis, I am not sure if you have done this kind of scenarios, but in financial tools, usually we do them. We go and analyze, okay, what's the best case scenario? Even it can be done for a year, before the closure of a year, let's say during the COVID-19. we can do, or we could have done, or we can still do a scenario analysis. Anytime you can do that. Scenario analysis, okay, if things improve, this will be the budget figure. Like, for example, now we are short on the budget on 5 million riyal. And the best case scenario is that we will be able to go and close that gap. And let's say, given the market, no, I can see even we can cover more than that and we can make it 6 million. This is the best case. The worst case scenario is that this gap of 5 million, it will continue and that gap will be more. By the end of the year, I will close at a gap of 7 million. So -7. Most likely scenario will be is that I will be able to do some improvement and bridge the gap, but I will not be able to close the 5 million because the last 3 months were very heavy on me, but I can lift it and we can close the year with only a budget deficit of 3 million riyal. So these are the base case scenario, most likely, worst case, the pessimistic, and the best case. Risk handling, risk mitigation. We covered the mitigation earlier in terms of risk. Now for financial terms, again, the financial has its own risk. So it's the process that identifies, evaluates, selects, and implements options in order to set risk at acceptable levels, given program constraints and objectives. Fundamental cost concepts. Now we're talking about costs. How do we recognize costs? What are the costs? I've been covering some of them as we move along. Here we will detail them. Variable cost, so it's a cost that changes in proportion with production output. If a company, in the sense of contracting or maintenance or whatever, if it does business for 10 million riyal or 15, the direct costs will change. For 10 million riyal, you need this much people to execute the project. For 15, you're going to need more people. For 10 million, you need to buy this much products, and for 15, you need to buy more. So these are variable. Fixed cost is a cost that does not change with the increase or decrease in the number of goods. You are unlikely, if you achieve a sales of 15 million versus a sales of 10, that you're going to change your head office and change the rents there and change the salary of the manager and so on. So these are fixed costs. Your utility bill will still come in the head office the same, irrespective if you're making 100 million riyal or making 90 million riyal. Mixed cost, so it's a cost that contains both a fixed component and a variable cost component. So sometimes you have a mixed costs. What does that mean? Okay, maybe it means that you have a tired up structure. Let's say your accounting cost is going to cost you for the year 1 million riyal. But if you are going to have an additional revenue of 5 million, then probably they need to hire someone part-time, and that 1 million will become 1.1 million. So you have a fixed part of it. Total cost is the sum of all fixed and variable costs for a cost object. Direct costs, costs that can specifically be traced to an item or activity. So there are direct costs. So the direct costs for me to install this chiller are easily identifiable. I have direct costs. I have the cost of the replacement chiller. I have the subcontract which I'm going to hire to remove the old chiller. I have the cost of the rental of the crane, the cost of the contract to install the chiller, the cost of the generator that I need to hire to run the chiller, and so on. So these are direct costs which can be allocated. Indirect costs, they can be, you cannot allocate these indirect costs. So for example, that's why companies utilize different tools for cost allocation. For example, the cost of your accounting staff. If they are for the whole organization, how are you going to allocate them on a specific project? Some will say, okay, you can allocate it by how many hours they spent on handling this or that, and sometimes it's more difficult than this. Cost measurement systems, okay. We are having the way the costs are, let me cover this previously, wait. Yeah, so we had this direct costs, indirect costs. Direct costs, direct labor, direct material, manufacturing supplies. These are direct. Indirect include rent, utilities, and general office expenses. So cost measurement systems is that how you measure and allocate costs. So you identify the costs, what are the costs, and then you start, some costs can be allocated to activities. So as I mentioned, direct costs are easy. Like, okay, to install this chiller, we have 5-6 projects. We are having the replacement of 5 chillers in different projects across the country. So some costs can be allocated directly to activities. So on this project, okay, it required the installation of a chiller at 100-meter height. So I had to hire a 2,000-ton crane. That cost I can allocate it directly to the activity, or I can trace it to that cost object. But sometimes we have unallocated costs. So as I said, okay, the cost of the for all the teams, for example, I had to do a general training for everyone. So this is a cost which is not allocated. I did for the whole organization. So it's unattached but not totally forgotten. So you need to maintain that. Differential cost. Differential cost is the cost difference between the cost of two alternative decisions or a change in output level. The concept is used when there are multiple possible options to pursue, and a choice must be made to select one option and drop the other. Differential cost. So the cost for me to do project A versus project B. In project A, I have to invest 1 million riyal. Project B, I have to invest 1.1 million riyal. The differential cost is 0.1 million riyal. This is the differential cost. Opportunity cost. This is a concept, let us see if you are familiar with. Opportunity cost is that represents the benefits and an individual investor or business misses out when choosing one alternative over the other. So it's the opportunity cost. What does that mean? I have, just give me a second. I have project A. Okay, and the project A, I will have to, it will generate income of 1 million QAR. Project B generate income of 1.1 million QAR. Okay, I have these two projects in front of me. Let's say I am doing a quality, not a quality, an audit of the energy utilization, and I get presented with two projects. One will be for the installation of solar panels, and if I do the project installation of solar panels, I'll be able to generate an income of 1 million riyal. Another one would be, for example, for replacement of one chiller. If I do that, I will be able to generate an income of 1.1 million riyal. If I select option B and not option A, what is the opportunity cost? Answers?
100,000 Qatari riyal.
Huh? Come again?
100,000 Qatari riyal.
Well, no. The opportunity cost is 1 million riyal. So
basically, what is the cost then?
No opportunity cost, it means that you lost an opportunity. Who said that I could not apply both projects? Let us say someone, your friend comes and tells you, look, if you buy a car, this car, I have two projects for you. If you buy this car and sell it, you will be able to generate 5,000 riyal. Also, if you buy this mobile and sell it, you will be able to generate 1,000 riyal. Okay. So if you went only for the option of the car, the opportunity cost is 1,000 riyal. because you could have also done both and you could have generated 6,000 riyal. This is what opportunity cost means. So it's the missed opportunity cost, if you want to call it like that. That doesn't mean. So the benefits of an individual or business misses out. So this is the missed opportunity cost. Okay. A sunk cost. Sunk cost is a cost that has already been incurred and cannot be recovered. Sunk costs are contracted with prospective costs. So sunk cost is something that you have already incurred as a business. Sunk costs are contracted with prospective costs and whatever. An important tool about sunk costs should be ignored in decision-making process. What does that mean? It means that whenever you want to look into a decision and there are some unavoidable costs that you have already incurred, you should think beyond that and ignore the sunk costs. Maybe they are part of your calculations, yes, but you should ignore them because they have already incurred this. So project B already has reached a certain level and it fell down and it didn't do that. So let's say an example. Someone did a real estate development, okay, and they paid 100 million riyal on it, and it reached a point where it lost financing, and the project was put on hold for 10 years. Okay, then you come and analyze the project now, and then they tell you, okay, what's the option moving ahead? You should consider the costs of the future compared to the revenue of the future. So this is the concept of the sunk costs. We continue with this. There are certain tools which can be utilized, which are for financial statement ratios. These are normally utilized to compare two companies of the same performance. You're comparing yourself to the market, apple to apple, and so on. I wouldn't tend to look much into the details of this. They can be somehow complicated, but you need to know the basics of these things. Financial statement ratio analysis. Usually these are done, for example, let's say, ratio analysis are done. Okay, for example, a company in the construction sector should have a certain expected revenue compared to the operational cost of it, okay, or compared to the assets in it. So that's why we use this ratio analysis to compare yourself to the market or compare company A to company B when you are buying stocks. There are several tools to do that. One tool is the current ratio. Current ratio is a liquidity ratio. Liquidity ratio, it means how liquid the organization is. It measures whether or not it has enough resources to meet its short-term obligations. It means that this company can pay its current debts, and it has debts and so on, and suppliers. The current ratio managed to pay off its current liabilities with its current assets, such as cash, account receivable, and inventories. So it's the ratio of the current assets to the current liabilities. A quick ratio or asset test ratio is a more severe liquidity ratio, okay, in which the ability of a company to pay its current liabilities when they come due only with quick assets. It means only we're considering the cash and market securities over the current liabilities. So the current assets includes also, for example, accounts receivable. Here they are not included. Asset management ratios. So liquidity ratios measured how liquid they are, the company. Asset management ratio is to measure the firm's success in managing its assets to generate sales. So it is the ratio of the sales to the account receivable. An important tool which is common to everyone, the profitability ratio. So profitability ratio is how much the company is profitable. The gross profit margin is the difference between revenue and cost of goods sold divided by the revenue expressed as percentage. Remember that financial statement which we looked at. So this is the gross profit. This is the gross profit. If we take the gross profit of 350,000 divided by 500,000, we get what we call as the gross margin. And if we take this one and divide it by the 500,000, we get the net margin. So these are the profitability ratios. So the operating profit margin is the profitability ratio used to calculate profit prior to subtracting taxes and interest charges. This is called the net profit margin. Return on asset is an indicator how profitable a company is relative to its total assets. So the return on assets. What does a return on asset mean? Just a minute. Return of assets. So this is, tenders can be an opportunity cost. I don't know what do you mean a tender opportunity cost. I will open the thing later on. Yeah, if you lose a tender, there is an opportunity cost which you lost, yes. But usually it's not measured like that. It's usually measured with things that you can, if you don't do them, what will happen? This is talking about winning a job. So return of assets is an indicator how profitable a company is relative to its total assets. So what does that mean? So if I'm a company which has an assets of 1 billion riyal, I have so much factories and whatever, I have 1 billion riyal, and I'm generating out of this 1 billion on a yearly basis, 5 million riyal. Whereas there is other company which is generating the same 5 million riyal, but they have only 200 million riyal in assets. Okay, so it means that the company which is having less assets and generating the same return is more efficient than me in managing my assets. Return on equity is the same thing, but in relation to the equity, also known as the net assets. So it means that the net assets minus the liabilities. As I said, I wouldn't go much into these, but these are general tools for you to understand that are used to compare companies and profitability. Strategies for cost containment. What is cost containment? Means cost control. The golden word everyone is using, cost control, cost control. Cost control is important, but yet it has to be done without long-term damage to the company. What does that mean? I can take certain shortcuts in cost control, but if I'm taking a cost control measure which is affecting for example, I was putting on a project A to maintain it. I had 100 people, but for me to do cost control, I now put 75. Okay, at what cost I did that? I did this on the cost of I'm becoming very much less responsive to the client. So if I'm less responsive to the client, on the long term, the client is not going to hire me again, because they will go and say that we are a cheap company, we are a company which doesn't meet its obligations. So you have to be very careful on cost containment. Cost containment strategies is a business practice of minimizing expenses to improve profitability, but without long-term damage to the company. An effective cost containment, okay, is likely to face challenges, resistance from employees, contractors, and customers. Proper change management must be in place to overcome obstacles. Chargeback is sometimes here referred to as back charge. Same principle. It means that you charge back or you get charged back for things as a way to, as a punishment, or it can be as a penalty. It happens a lot in FM contracts. There are penalties and chargeback. They say, okay, we will pay you 1 million riyal per month. But if you are having this much slow response time, if you didn't do these PPMs on time, we're going to be deducting this much from you. Or let's say that sometimes what happens is that you go and send to your contractor, subcontractor, you tell him, okay, you are delayed on the execution. If you are not able to do it within the allocated time, I'm going to hire another company to do your task, and I'm going to back charge the cost which I incur by hiring someone else to you. Procurement. Okay, what's the difference between purchasing and procurement? Anyone? Anyone can tell me the difference between purchasing and procurement? No one?
Unfortunately.
Already given here. So.
Yeah, Najita. Yeah, you were saying, Najita, please.
Yeah, it's already given here. Like, yeah, for procurement, we always have to follow some processes. You know, we have to get minimum number of quotation. We have to get the technical criteria meeting. We have to check the commercial criteria meeting. So we have a set of requirements, and get the best quotation with meeting all our requirements with lowest cost. Usually, most of the organization follow the procurement procedures.
So basically, you are right. Basically, purchasing is part of procurement. But if you look at the chart, but purchasing is usually for off-the-shelf items. Purchasing is done when I particularly know what I want. For smaller items, usually pre-designed commodities. For example, I will go and buy, I need 100 galvanized sheets, 3 mm, 2x4 or 4x8. Okay, so I go and just purchase it. I will go and get 3 quotations and I go and purchase it. Procurement is a more detailed process. It depends on requirements, specifications. Let's say if I want to buy a pump, okay, a big pump, a chiller pump, for example. I want to buy 20 chiller pumps, and there are requirements. They need to have this much head. They need to come with this warranty. They need to have this much specifications. The impeller should be made of stainless steel. They should have this much test requirement authorized by a third party, and so on. So this is the procurement. So the procurement is a more formal and process of finding, agreeing terms, and acquiring goods from an external source, often via tendering or competitive bidding process. Purchasing is a methodology of how goods and services are ordered. So purchasing is part of procurement, but procurement is more comprehensive. Procurement is not the same in each organizations. So for biddings, so what's the difference between the request for a proposal and the request for quotation? This is another question.
Proposal is like a full package. It can be mostly. Quotation, maybe it's just part of it, you know, small.
In a certain way, but usually for quotation, you know what you want. For a quotation, you know, I need to install, what do I say? Let me say something. I need to construct one room outside this building. It has this dimensions, this height. You need to use this kind of block. You need to use this kind of plaster. You need to use this kind of this, and these are the drawings. So I'm calling a request for quotation. I already am giving you as a supplier all the information that you need for you to generate the price. Request for proposal, it's more open-ended. I am telling you, I need to have a building. Let's say I'm asking for a request for proposal for I need you to construct me a guard room which has these functional requirements. I'm just giving you a certain thing. And then you are supposed to come back to me with a proposal, with the design, with the criteria, with so on. So a quotation on one end, I'm asking you and I know what I want. A proposal, I'm leaving it for you as a supplier to suggest what is there. An invitation to tender is a formalized tender usually done for open tenders. Contract may be awarded for the following factors: lowest bidder, Again, of course, price is very important, but usually tenders are evaluated based on the money best value. That's why common tendering procedure is that we will have we ask the suppliers to provide a commercial and a technical offer. And technical offer is that to secure and screen not necessarily the lowest price. Maybe they're taking some shortcuts in the way that they are suggesting that they will build this room, which is not suitable for us. So we're looking at the best value for money. Otherwise, people would have always went and purchased the cheapest stuff. People go and buy Mercedes trucks for a reason. They can go and buy cheaper ones, but why they go and buy Mercedes trucks? Because someone sees it as a money best value. They see a Mercedes truck is more reliable, less likely to break down and disrupt operations, and so on. Risk assessment. Again, risk plays an important role, and that's why sometimes you ask contractors to pre-qualify with a certain number of projects, and you are weighing the risks. Okay, even you can be a very qualified contractor, but you don't have experience in this part. So I go with option A. Julius, can you clarify your questions? Recommendation for improvement? What are you talking about exactly? Julius? You are muted.
Regarding request for proposal, sir, is this similar to the recommendation for improvement to specific facilities?
No. Request for proposal is a procurement process.
Okay. Clear, sir. Clear. Okay, thank you, sir. Thank you.
Procurement and facility management outsourcing. Outsourcing, what's outsourcing? Is a version for a make of buy decision used for services. So outsourcing, it means, shall I do it myself or shall I give it to someone else to do it? Even if I'm a facility management company or I'm handling facility management, some people even outsource the whole thing. Some companies, they don't do anything. They just have a facility manager, and they go, and even they don't have a facility manager, and then they outsource the whole process to someone. Why would you outsource? Or even some facility companies, they focus on hard service. Why FM needs to outsource? There are many advantages for outsources and disadvantages. Disadvantages would be the loss of direct control. When you're giving a certain thing to your staff, you will have better control over it. When you're outsourcing it, you have less direct control. Why you outsource? Usually cost containment opportunity. If I, for example, go for a specialist, let's say for the maintenance of CCTV systems, rather than they are specialized people and they will have their teams and the way they handle the things, it will be maybe then much more cost effective for me to do it through them. Okay. Expert not available in-house and can be obtained. So I don't need to hire an expert in elevators and an expert in CCTV and keep them on my payroll. Outsourcing provides me with flexibility and a cost. This flexible costs, as I said today, maybe I have 10 projects which require for me to have an elevator expert, but maybe next year I will lose some of them. So this provides me with flexibility. Opportunities for FM staff, eliminates capital investment. I mentioned regarding the cranes and whatever, maybe whenever I need access, I make a contract with the company that provides access. Usually what we try to outsource are the non-core function of the organization. So items that are good for outsourcing are items which are non-critical. Items where you can get savings which are non-critical. Whatever business you're having, whether it's for FM or non-FM. You cannot be, for example, an IT specialized company or a company which does ELV systems, and you go and outsource your CCTV. That's not gonna be like a smart decision. Usually you outsource things which allow you to focus on the main area of service that you are providing. So you do it to concentrate on expertise and resources available in-house. What's a contract? A tool which we use to formalize the procurement or the contracts with someone else are contracts. Okay, contract. What's a contract? A contract is a promise or set of promises that are legally enforceable and, if violated, allow the injured party access to legal remedies. There are different types of contracts. There is a bilateral or a unilateral contract. Bilateral, it means both of us sign on it. A unilateral is a one-way. For example, I can send you a purchase order. So I'm sending you a unilateral. It's a commitment from me to purchase for you. You may not have it. You can say just simply reject it. That's it. Express and implied contracts. Express contracts are stated out contracts. Implied contracts, it means that they are implied throughout the transaction that we had. Illegal and void contracts. Certain contracts are illegal, and a typical example will be is that any contract that you do with a minor is void by law. You cannot sign a contract with a person less than 18 years, depending on the jurisdiction. Here, for example, a type of contracts that is void is that you cannot, this 49-51% way of the company is formed, you cannot sign a contract outside of that mentions other than this. So depending on the jurisdictions, there are certain contracts which are not even considered by the court of law. They will not recognize them. They just dismiss them. Purchase order is a document signed by a contracting officer and addressed to a contractor or supplier for the future delivery of supplies, equipment, and so on, in exchange for a promise by the government to pay the stated price, the government or private entity. Fixed price contracts. Fixed price are a form of pricing that includes a ceiling beyond which the buyer bears no responsibility for payment. This is what we call here like a fixed price lump sum contract. I tell you, lump sum contract for you to install for me to construct and install for me a generator room outside is going to be 150,000 riyal. It's a fixed. I don't care what cost you have, what cost overruns. It is your problem. Cost reimbursement contracts. So sometimes you sign a contract where it is called a variable price contract or cost reimbursement, which is called as a cost plus contract. So there can be different cost plus contracts. So it can be cost plus fixed fee. Cost plus fixed fee. Contracts pay a predetermined fee that was agreed upon the time of the contract confirmation. For example, I tell you that I will pay you your costs. Come and construct for me this room. I will pay you your costs plus a 1 million riyal cost. So no matter what your costs are, you're going to show me your costs. I will cover your costs and I will pay you your personal fee for the next 1.5 years for 1 million riyal. Cost plus percentage of cost. I will pay you your cost plus 5% on all the bills that you come. Cost plus award fee upon the contract's work performance. When you complete, for example, I'm going to give you this much. Cost plus incentive fee, which meet or exceed performance targets. So, for example, I will tell you that I will pay you this plus 5% in the cost, but if you are able to finish this project for less than 1 million riyal, you will get from me an additional 100,000 riyal. So that's why I'm incentivizing you for you to reduce my cost so that you don't come with an overrun. Other contract types, indefinite delivery quantity or line item contracting. I can sign an open supply contract with you, and it happens a lot in companies where, okay, I'm gonna buy from you, for example, safety shoes. I fix it at 100 riyal. Okay, I don't put a quantity. I make it for 6 months, renewable, and so on. National Bank. Yes, Rita.
Is it a call-off agreement, indefinite delivery quantity?
Excuse me?
Is it a call-off agreement we can?
Yeah, it can be. Yeah, this is a call-off contract. Yes, call-off basis. line item quantity. So an indefinite delivery quantity. I'm just fixing the term, and I can fixing the prices, and I'm fixing the delivery terms, I'm fixing the payment terms, and I'm doing it to regularize your side of the story and my side. I make it easier for my team to purchase. National buy contracts, open book contract, labor, open book where like they show you the cost and I cover you based on this. Labor, hour, time, and material. So time and material, I tell you, okay, come and do this work for me, and I will pay you for the labor. I will pay you the welder at 20 riyal, the mason at 15, and so on. Types of contact fraud. Contact fraud may take place in different forms. Cartel. Cartel is that when you have a group of companies or individuals who are regulating the price on the market, and they are maintaining high price and restricting competition. You can think of this happens usually when there is no competition, and that's why they put regulating bodies. So for example, Ooredoo, Vodafone, previously it was even a monopoly. It was only Ooredoo or QTEL. Collusion between personnel or agents. Collusion is that you have someone who is giving you insight on the price. This is called collusion, having conflicting interests. Irregularities during execution of the contracts. You told me that you're going to utilize this much quantity of steel or this grade, and you use the lower grade. This is contract fraud. Non-competitive pricing of contracts. Payment for work not carried out, or price fixing. So there are many types of contract frauds. There are several ways to do it to prevent contract fraud. One of the most important is a budgetary control. You always maintain the budget. You have a budget of this much. That's why managing and managing budgets is important. Change order controls. Who issues the variations for the, that's why usually a critical part of any contract will be how the variations are handled. Who approves what? Okay, change order controls, competitive bidding, tendering. So it starts from the process itself. That's why in government contracts, it's an open bid contract. It's very clear. You have to pre-qualify. You have to have this much contractor classification. It has to be reviewed and so on. Documentation and record keeping. You document everything so that you can come back to it. Proper authorization, who authorizes what and purchases internally, the delegation of authority, segregation of duties. So that's why, for example, as I said, we have like some people who do the technical review, some people who do the commercial review, so that there is no collusion. And there are many tools which are utilized, and many people are creative and they still find ways around them. But it varies. It's better to have controls, and it changes with the culture of the organization, the culture of the country, and so on. Shifting staff around, you rotate people, you shift people around to prevent fraud. Service contract. So the service contract is a contract for the performance of various label-oriented services. Service specifications are included in a separate document developed and agreed upon in order to clarify and give further detail on expected service level, and that's what they call the service level agreement, and the quality. So you put service specifications in that. Providing finance. So that's it for today's topic. I hope it wasn't dry. Yes, Sheikh. Sheikh, you raised your hand.
Yes, I wanted to just briefly understand for facility management, usually what kind of budgeting we do? Is it like fixed budgeting or variable budgeting? What it implies here?
What do you mean
like,
regarding what?
For me, I understand like usually FM contracts are like kind of very fixed budgets. Like we have you are given a tower with 100 million, and you know that this 100 million will be fixed. So you will employ 25 people, staff, and the equipments will be so and so. So it's like kind of fixed budgeting.
Usually the regular thing for companies is that this is on the project level if you want to do it, but normally we do a fixed budgeting level, because even the production units, or whether it's in the manufacturing or whatever, it's budgeting. Just for you to tell you how the budget can change. So usually we have a fixed budget, not a variable budget.
However,
all right, so like for example, all these companies, public listed companies and all, they don't leave it variable. They will say, okay, we are expecting to sell 100,000 units of Samsung mobiles next year. So even that, and they fix that, and then they work everything around it. All right, providing financial information for internal users. This is the key word. Is
management accounting.
Yes.
Management accounting.
Yes. Which budgeting method requires a facility manager to justify all budgeted expenditures, not just changes in the budget from last year?
Zero-based?
Yes.
Zero-based.
Correct. All of the following statements accurately characterize sunk costs, except
A, they can be eliminated in whole or in part by eliminating an activity.
D
A.
should be ignored.
Yeah.
should be ignored.
Yeah.
Hey,
can be eliminated in
when I mentioned sunk cost, I only mentioned one thing.
Ignore
They should be ignored in decision making. Right, these are accurate, so it means that this is the wrong. So it means that this is correct. Cannot make any difference. I'm sorry, I have to check this. I'll get back to you on this one. Accurate, characterize.
These are accurate.
Yeah, they should be ignored. They can be eliminated by eliminating an activity. Yes, this is the wrong one. You are right. A facility manager is working with the procurement officer to secure a new provider for janitorial services. At what point in the procurement purpose should a service level agreement be drafted? So usually at what point, whatever contract that you are making, there is an ideal way. At what point do you make the contract?
At the bid, during the bid time.
During the bid time.
Because then only they will know the terms and conditions.
100%.
While FM prepares for procurement request.
So when is this?
See, because otherwise they will not prepare the cost.
You are right in the way you're thinking, Najita, but in this case, it's like in the initial state, the most initial state.
Okay, yeah, when we prepare the yes.
Yeah, so when you initially start thinking about it, and you are right, that's why normally even the tenders, they will include a form of the contract agreement, because the person responding to that should understand what kind of contract is he or she expected to sign. Okay, facility management decides to outsource administrative services.
I was thinking on the when we initially, from my client perspective, when we initially do a bidding for a maintenance contract.
Yeah.
That's the perspective I was thinking.
Yeah, so it's there, yani, when you are thinking. So the earliest, the possible.
Yes.
Okay. Facility management decides to outsource an administrative. Huh? Someone, I'm having so much backward noise from someone. No. Anyhow, so what's the answer to this one?
C.
If you look at the options, C is the most likely. Yes, because you are outsourcing for a reason. Yes, Ahmad.
But for administrative services, is it really, we don't look for technical competence, isn't that critical?
It depends what kind of administrative services that you are. Let's say you are a company, a Qatari company, and you go and open a branch in, let's say, Singapore, okay? And you don't understand how the method of operandi is there. And then you outsource your administrative services to someone. Why? Because they technically know how to do the country more than you do.
Makes sense, yeah.
I know many companies, multinational companies, which come to Qatar who outsource their administrative services locally because they simply don't know how to navigate. So they're going to someone who are more technically competent to handle this. I know like companies such as Doosan and many Korean companies and others as well. A contract where both parties promise to do something, one promise is given in exchange for another, is described as a
bilateral.
Bilateral. Which of the following items would not be part of the general condition clauses? Which will not be part of the general condition clauses?
Change order.
General condition clauses is a clause, are clauses which you put irrespective of the contract. Let's say you are a company building something and you need 10 contracts sent out. You need one for the civil guy, one for the mechanical, one for the electrical, one for the one who's handling that. So the general clauses, which one would not be part of it?
B. Specification control over the
Yes, that is the most specific one. Change orders, it means how you will handle the change order. And this is a general condition. Terms of progress payment is a general condition. Alternate dispute mechanism is a general contract condition. A facility manager is assessing a contractor's performance for an elevator maintenance contract. All of the following would be valid performance criteria except. So you are making a contract for a performance of an elevation maintenance contract. Which ones are a valid criteria except one? One is not a valid criteria.
B. Receipt of an
Receipt
industrial.
of industrial variable.
You are right. This can be used as a way to evaluate, but not as a performance criteria. Okay. Which of the following statement describes risk assessment? Consider the word risk assessment.
C.
C.
Yes. C, because it's assessment. You're assessing. You're just analyzing, considering the likelihood and the impact. That's it. That was it for tonight. Ahmad, you had a question?
Yes, actually, I was wondering about there is a word always I hear it, but I don't understand it. So if you kindly explain to me.
Which word? Come again?
Yes, I will tell it in Arabic because actually perhaps I don't know the خطاب الضمان حضرتك. بسمع حضرتك كلمة خطاب الضمان بسمعها كتير في المشاريع بس أنا مش بفهم إيه معناها. فممكن حضرتك توضحوا لي حتى بالعربي يعني إذا تسمح.
No, I will translate it and then so everyone can understand. So he's asking me about something which is called the performance bond or a bond. What's a bond? A bond is a promise of a payment. What kind of bonds we utilize and usually in contracting? The first bond that you put is a tender bond. Usually when a tender is put in place and they ask for different companies to come and place a price, the person who is asking this asks the companies to provide as a tender bond. What is a tender bond fee? A bond is sort of a promise of a payment. It's like a post-dated check. You can take it and you can encash it from a bank. So why do we do a tender bond? A tender bond, we do it is that if I have 5 contractors, let's say one got it and priced it at a certain amount. And then when I went and gave him the contract, he ran away because he found out that he priced it wrongly. So that's why I asked them to do a tender bond. After they get the contract, I ask them to submit a performance bond. Performance bond, it means that there's a guarantee from the contractor to me that he's going to go all the way through and execute the contract. So this is what you call performance bond or خطاب الضمان. Clear?
اوكي اوكي. بسمع على حاجه يسيل خطاب الضمان يعني بيقول liquidate yeah liquidation yes.
So to liquidate the performance bond, it means see, I as a client who gave you the contract, okay, you gave me a performance bond that you're going to execute. Down the line, I find out that you're not executing. Okay, I go and I exercise my right and I take it to the bank and liquidate it. It means that it's the same story as you're giving someone a PDC. PDC, a post-dated check. You are giving now your your landlord, when you rent out, you give him 12 checks and you give him one check which is called a guarantee check, right? A guarantee check is a tool which he uses to guarantee his rights that you're not going to sabotage his equipment or sabotage his property. Similar in a contracting perspective, you issue this performance guarantee. Unfortunately, many people use it unlawfully, to use it as a pressure against the contractor, and they go and liquidate the bank guarantee.
Yes, this is a question here. When I started to liquidate, I saw the owner, for instance, the landlord, if you didn't do this, I will liquidate this. So
exactly.
Yes, at which state, at the ending and the handing over, or this is like retention?
No. Usually the way performance bonds are done, if you read them, they are usually done, they say that you are supposed to give a performance guarantee, and if you read the performance guarantee, it doesn't even qualify anything. It is done in such a way, the moment he goes and tells the bank, cash it, they will encash it. But then it goes into the legal repercussions. You can do it at any time of the contract. This is a performance bank guarantee. You are expecting him to meet certain performance requirements. If he's not meeting it, you can go and liquidate.
So the contractor can do objection why you liquefy it. I am doing my work, so it can be dispute.
Yes.
It is a reference
yes.
to
Usually the way contracting is done in this part of the world, and particularly in Qatar, is not an ideal way. It's usually one-way street where the client is having a higher hold on the contractor. In other parts of the world, it's usually much more democratic. And that's why there is the FIDIC contracts, in which it balances out the relationship between the contractor and the client. Okay.
But many projects, Mr. Baha, also, too many projects, they will not allow you to do the project until you make this. This was called خطاب الضمان.
Yes.
Accept it unless you have to do that.
Yeah, it's a requirement. It's a requirement.
حضرتك بالبلد كده لو يدراع حضرتك لا مش ما عندكش خطاب ضمان مش هقدر مش عارف حضرتك
Yeah, this is it is not done for its intended use. Unfortunately, it's pushed and used as a way to push the contractor. The original intent for it is to guarantee the rights of the client. But the way it's utilized can be different sometimes. Sometimes it's used as a pressure even for the contractor for him to provide a discount. These are all unethical practices. This is not the subject of our discussion.
But it's not here in the FM in business. We didn't face it. We didn't face it here in the course. This letter of guarantee or letter of guarantee.
It will be covered somewhere else. The bonds. It will be covered. Yes.
Shukran. Thank you.
Okay. Anytime. Sheikh.
I wanted to know, as you've mentioned, types of contracts, but when as far as facility management is concerned, I have heard more of like comprehensive and non-comprehensive type of contracts. In this regard, I just wanted to clarify that I was working with one company who has a type of contract which like manpowers are will be supplied by the contractor, but the paid, the contractor will buy and they will have like plus percentage and backcharge the client. What it fall in which category? Comprehensive or non? I'm not clear
Cost
on this.
plus contract. This is a cost. It can a contract can be a mix of all these terms, but that specific one where you go, for example, I can have a lump sum contract, okay, a lump sum contract where I provide the manpower, or a fixed price contract, I provide the manpower. And whereas, for example, for the material purchase, it's very common that spare parts will be subjected to a cost plus clause. Like on every item you purchase, I pay you for it a 5% as a management and processing fee. Okay?
Okay, okay. So it was like combination of contract. All right, thank you.
All right. Okay. If there is nothing else to add, I will be closing the session. All right. Thank you, everyone. Enjoy.
Yeah, thank you, sir.
Tell me. Yeah. Again. Yeah, credit. You know, when you credit your account, okay, I go and you pay me by crediting your account. You're increasing your liability. It means that you are going to have a liability for me. You bought from me on credit a mobile phone for 3,500 riyal, right? Your liability will increase by that amount, right? And down the line, your asset, your bank account is going to be decreased by that amount, right? Yeah, so this is the transaction. All right, all right. Any other question? Okay, if not, then I'm going to be closing. Good night, everyone.
Good night.
Anytime, good night.